What if your portfolio paid you $5,000 every single month? Not someday, but as a real, achievable target based on your current situation. The amount you need to invest and the time it takes will look different for everyone, but here's what most people get wrong. You don't need millions in the bank to make it happen. You just need the right strategy and the patience to let it work. In this video, I'm breaking down exactly how much you'd need to invest, why SCHD is one of the best vehicles to get you there, how compounding turns small contributions into serious income, and how, no matter where you are in life, you can build a portfolio that pays over $5,000 a month. But first, let's talk about why $5,000 is the number that actually matters. Why $1,500 a month just doesn't cut it anymore. A lot of people chase $1,500 or $2,000 in monthly passive income and call it a win. And honestly, a few years ago, that wasn't a bad goal. But in 2025, that number barely scratches the surface. According to the Bureau of Labor Statistics, overall inflation climbed 2.9% over the past 12 months. Food prices are up 3.2%. Core inflation sits at 3.1%. And while energy costs only nudged up about 2%, that small relief hasn't done much to offset how expensive everyday life has become. Here's what that looks like in real dollars. Groceries now run $900 to $1,000 a month for the average household. Gas is sitting near $3.40 a gallon. Electricity averages 17 cents per kilowatt hour, noticeably higher than just a few years ago. And then there's housing, the real budget crusher. The median monthly rent in the US is now $1,539, up from about $1,470 just a year ago. Over the past few decades, rent has grown at nearly 4% per year, while wages have consistently struggled to keep pace. The Census Bureau confirms it. The average American now hands over 26.6% of their income to rent alone before a single grocery run, utility bill, or tank of gas. Add it all up, and a typical household is easily spending $3,000 to $4,000 a month just on the basics. That means $1,500 in passive income covers maybe half your bills. It helps, but it doesn't give you freedom. $5,000 a month does. That's enough to cover your essentials, stay out of financial stress, and actually enjoy your life. So let's talk about the ETF that makes this goal realistic.
Why SCHD is built for this. If you've spent any time in the dividend investing world, you already know the name. SCHD, the Schwab U.S. Dividend Equity ETF, has been one of the most trusted funds in the space since it launched back in 2011, and for good reason. It does one thing really well. It finds large, financially solid American companies with a long history of paying and growing their dividends and packages them into a single low-cost fund. The expense ratio is just 0.06%. That's $6 a year on every $10,000 you invest. For that price, you get access to a fund managing over $69 billion in assets. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which sounds fancy, but really just means it's looking for companies with strong balance sheets, steady cash flow, and at least 10 consecutive years of dividend payments. These aren't startups or speculative bets. They're mature, battle-tested businesses. Right now, SCHD holds about 103 companies across sectors like energy, consumer goods, healthcare, and tech. Some of the biggest names in the fund include AbbVie, Lockheed Martin, Cisco, Merck, ConocoPhillips, Coca-Cola, and Verizon. The top 10 holdings make up about 40% of the fund, a concentrated bet on quality. What about performance? Over the past year, SCHD dipped about 5.9%, while the S&P 500 climbed 13.4%. Over 3 years, SCHD gained 18.2% compared to the S&P's 81.4%. 5-year numbers tell a similar story. Now, before you close this tab, context matters here. The S&P 500's recent surge has been almost entirely driven by a handful of mega-cap tech companies, the so-called Magnificent Seven, riding the AI wave. Strip those out, and the picture looks very different. That concentration also means more volatility. SCHD, on the other hand, is built for stability and income, not moonshot growth. When interest rates stay elevated, dividend stocks naturally lag, and that's exactly the environment we've been in. Under the hood, SCHD's fundamentals are solid. Average company market cap, $136 billion. Price-to-earnings ratio, 18, not overpaying for profits. Return on equity, 28%. These companies are genuinely good at generating returns. Beta of 1, moves with the market, not against it. Liquidity rating, A+, with over 16 million shares trading daily. It's a fund you can buy in any amount and sleep well holding for decades. The power of reinvesting, Josh versus John. Before we get to the numbers, you need to understand why compounding is the real engine here, because it's the difference between a decent portfolio and one that pays your bills for life. Take two friends, Josh and John. Both invest $10,000 in the same ETF. The fund grows at 6% per year and pays a 4% dividend yield. The only difference? What they do with those dividends. John takes his dividends as cash every year. Year 1, $10,400. Year 5, about $12,248. Over 5 years, he picks up about $2,248 in growth and $2,200 in dividends collected. Not bad. Josh reinvests every dividend through a DRIP, dividend reinvestment plan. Every payout automatically buys more shares, and those new shares generate their own dividends. Year 1, $10,400, identical to John. Year 3, about $11,700. Year 5, about $14,400, nearly $2,200 more than John. Same fund, same investment, same yield, the only variable was reinvestment. That gap, 15% more value over just 5 years, becomes a completely different universe over 20 or 30 years. This is the foundation of everything we're about to look at.
The 3 paths to $5,000 a month. SCHD currently pays about a 3.83% dividend yield. Over the past decade, those dividends have grown at an average rate of 10.43% per year, and the share price has appreciated roughly 7.69% annually. Now let's put those numbers to work. Path 1, 30 years, $7 a day. This one is for anyone early in their journey who has time on their side. Contribute just $7 a day, about $210 to $220 a month, consistently for 30 years, reinvesting every dividend along the way. Year 1, about $2,555 invested, portfolio just getting started. Year 10, about $45,000, generating roughly $2,000 a year in dividends. Year 20, about $270,000, paying out close to $11,000 annually. Year 30, about $920,000, generating roughly $65,000 a year, about $5,400 every month. Total out-of-pocket over 30 years, about $76,000. Final portfolio value, about $920,000. Time and patience did the rest. Path 2, 20 years. Start with $60K, add $15 a day. In your 40s and don't have 3 decades to wait? No problem. You just need more fuel at the start. Begin with a $60,000 lump sum, then consistently add $15 a day. Year 1, about $72,000 portfolio, about $2,300 in annual dividends. Year 10, about $284,000, generating about $12,000 a year, about $1,000 a month. Year 20, about $1.1 million, generating about $61,000 annually, about $5,100 a month. Total contributions over 20 years, about $169,500. Final portfolio value, about $1.1 million. The upfront capital creates early momentum. Compounding does the rest. Path 3, 10 years. Start with $350K, add $50 a day. Want to get there in a single decade? This is the accelerated path, and it trades time for capital. Start with $350,000 and add $50 a day. Year 1, about $480,000 portfolio, about $13,400 in annual dividends. Year 5, about $725,000, generating about $27,000 a year, just over $2,200 a month. Year 10, about $1.41 million, generating about $61,000 a year, about $5,000 a month. Total contributions, about $532,500. Final portfolio value, about $1.41 million. This path is built for investors with higher incomes or significant existing savings who want to create an income-generating portfolio within a single decade. The bottom line, 3 different timelines, 3 different starting points, 1 destination. Whether you're starting with $7 a day and 30 years of runway, or you're accelerating with serious capital over 10 years, the math works, because SCHD's combination of dividend growth, share price appreciation, and the power of reinvestment turns consistent contributions into something most people never believe is possible for them. The key isn't perfection. It's starting, staying consistent, and letting compounding do what it does. If you want to take this even further, I put together a video on how to earn over $8,000 a month using 5 compounding strategies. It's on screen right now. Go check it out.